So people have been making some purchases. You've been shifting your preferences and your universe. What'd you do?
So every quarter we learn more information. Stocks move around. They've been moving around a lot the last few months. And so we took an opportunity to step back, reassess our recommendations. Mainly what I did is I'd been a big bull on Amazon for the last couple of years. They've been my top pick. There have been some things coming up in the last couple of quarters that make me a bit nervous. Still a buyer, but it's not my top pick anymore. Preferring Alphabet now. Like what I'm seeing there, continued strong 20+% growth driven by YouTube, mobile search. But what I like there tactically is it looks like we could be seeing an improvement in expense growth and margins, and that's been an issue for the last year. So I think one of the reasons why Alphabet stock has not performed all that well the last year is the pressure on margins. We see maybe that coming to an end, and that to us tactically is a better setup going forward.
Larry, I'll put the same question to you, especially when you've seen double-digit gains just since the start of the year in some of the biggest tech names.
Well, I think, Morgan, the market is not cheap, and you have to be reasonably cautious. So at this period of time, I want to bet on the most certain horses. And if you look at the area of tech, what's the most stable, predictable cash flow? I think the answer is really easy, and Mark highlighted it for one of the stocks, which is Google. That basically the core business of Google, no matter how you define it, is probably going to grow between 18 and 22%. And the management, if they're going to play with the margins, it's the management's decision to play with the margins. And they now have decided they would like to see the margins a little higher, and that augurs very well for the future performance. The second one, where there's an enormously predictable stream of cash flow, is the services business in Apple. And you look at the services business in Apple, it's very, very hard in the next few years for you to conclude that it's going to be less than 15%. It's enormously high marginal profitability, so that means more than 20% growth in cash flow. It's growing as a percentage of cash flow. The stock is way cheap versus the others, and I think those are the two horses you have to bet on in the race.
On Apple, Larry, do you care about unit sales now? And second question, are you craving some sort of inorganic growth through M&A?
I don't think the inorganic growth is going to be there. The thing that most terrifies me, Carl, is people wanting to get into the movie business. I think if you're not going to change money incessantly at a foreign exchange booth or visit a slot machine at a casino, the movie business is the fastest way to turn $10 into $8. And I noticed that Amazon is retrenching in the movie business, having found that it's very, very hard, except if you're in the business of making big budget cartoons, to make any money. I think Netflix is, kind of fighting a rearguard action. They're spending a lot of money to see if they can get Roma Academy Awards. Right. I think this tells you they're a little bit worried. So I hope that there's no inorganic acquisition there. That would terrify me, especially if it's in the film production business.